A significant structural shift is currently unfolding within the global financial system, as a decades-old mechanism involving Japanese capital begins to unravel, creating substantial pressure on the United States economy. For over 30 years, the American financial landscape has been supported by the yen carry trade, a system where investors borrowed money at near-zero interest rates in Japan to invest in higher-yielding US assets, such as Treasury bonds. This consistent flow of Japanese capital acted as a hidden subsidy, artificially suppressing US interest rates, lowering mortgage costs and inflating stock valuations. However, as of 2026, the economic conditions that sustained this arrangement have shifted, with Japanese domestic yields rising to levels that make foreign investment less attractive. The timing of this withdrawal coincides with an unprecedented fiscal requirement for the United States government. In the current calendar year, the US Treasury must borrow approximately $11 trillion to maintain operations. This total includes $9 trillion required to refinance existing debt as it matures, and an additional $200 billion in new borrowing to cover the ongoing federal deficit. This represents the largest single-year borrowing requirement in American history. As the US seeks to find buyers for this record volume of debt, Japan, historically the most reliable foreign purchaser of US Treasuries, is actively stepping back from the market. Japanese financial institutions have already commenced the sale of foreign securities, marking the beginning of a long-term structural reallocation of capital back to their domestic market. This shift is driven by a fundamental change in the global interest rate environment where, for the first time in nearly 2 decades, Japanese investors can achieve higher risk-adjusted returns at home. When accounting for the costs of currency hedging, the return on domestic Japanese bonds now rivals or exceeds that of US Treasuries. This 1 percentage point shift in relative value is rerouting trillions of dollars in global capital. Consequently, the US is facing a dual challenge: a domestic need for record-breaking capital infusions at the exact moment its primary external source of funding is prioritizing its own domestic market. The resulting collision of these two opposing economic forces is creating new risks for the stability of long-term US interest rates and the broader economy. The core of this financial transition is being driven by 3 simultaneous economic forces that have reached a critical intersection in 2026. First, the Bank of Japan has moved away from its long-standing negative interest rate policy, leading to a dramatic rise in domestic bond yields. For the first time in decades, long-term Japanese government bond yields have climbed to levels that allow domestic investors to capture competitive returns without the inherent risks of currency fluctuations. Second, Japan's domestic fiscal environment has become increasingly volatile. With a debt-to-GDP ratio exceeding 250%, the Japanese government is currently implementing policies that increase public spending while reducing taxes, a combination that has triggered sharp spikes in bond yields and significant market volatility. As domestic conditions stabilize or offer better premiums, institutional investors are naturally repatriating capital. Third, the United States is concurrently experiencing its own internal fiscal pressures that amplify the impact of Japanese capital withdrawal. The massive $11 trillion borrowing requirement is being met with ongoing quantitative tightening by the Federal Reserve, which continues to reduce its own balance sheet. This creates a supply and demand imbalance. The supply of US Treasuries is hitting record highs, while the most significant price-insensitive buyers are exiting. The direct consequence of this shift is visible in the 10-year US Treasury yield, a benchmark that dictates the cost of mortgages, corporate loans, and equity valuations. Historical data suggests that Japanese demand previously suppressed these yields by approximately 50 to 100 basis points. As that demand evaporates, yields are rising independently of Federal Reserve policy, explaining why mortgage rates remain elevated even as the Fed attempts to implement short-term rate cuts. Specific Japanese institutions are spearheading this movement through rational, mathematical rebalancing. Japanese life insurance companies and pension funds, including the Government Pension Investment Fund, the largest of its kind globally with over $1 trillion in assets, are shifting their mandates. These entities are legally required to match long-term liabilities with assets. With domestic yields now providing sufficient returns, the necessity to hold U.S. debt has diminished. Furthermore, Japan's regional banks are under increasing pressure to rebalance their portfolios. Many of these banks accumulated significant foreign bond holdings during the era of low interest rates and are now facing unrealized losses as global yields rise and bond prices fall. To protect their capital buffers, these banks are liquidating foreign positions to bring funds back into the Japanese market, creating a persistent, incremental sell-off of U.S. securities. The long-term implications of this structural shift extend beyond immediate market volatility, signaling a fundamental repricing of the American economy.
Unlike previous financial disruptions characterized by sudden shocks, the current situation is described as a slow bleed, a gradual erosion of demand in the US Treasury market that is harder for policymakers to counter. As the price required to attract buyers for US debt increases, the resulting higher yields are expected to flow through every sector. For American households, this translates into permanently higher mortgage payments and restricted housing affordability. For the federal government, rising interest costs on the national debt are projected to add hundreds of billions of dollars to government spending, potentially creating a feedback loop where higher deficits necessitate more borrowing at even higher rates. On the global stage, Japan's move is forcing a reassessment of risk across all sovereign debt markets. Financial analysts note that when a nation with debt levels exceeding 250% of its GDP, like Japan, begins to pay higher yields, it sets a new floor for what other developed nations must offer to remain competitive. This global repricing is further complicated by external factors, including fluctuating energy prices and geopolitical tensions. If rising oil prices increase inflationary pressure within Japan, the Bank of Japan may be forced to accelerate interest rate hikes or intervene in currency markets by selling off its remaining US Treasury holdings.
Such actions would introduce episodic selling pressure on top of the existing structural withdrawal, further destabilizing the US bond market. The Federal Reserve now faces a significant constraint in its ability to manage this transition. While the central bank can influence short-term interest rates, it cannot control the global capital flows that drive long-term yields. Aggressive attempts to suppress yields through further rate cuts or renewed bond purchases risk reigniting domestic inflation and undermining the Fed's credibility. Consequently, the era of ultra-low borrowing costs and elevated asset prices, which was supported by Japanese capital for decades, appears to be concluding. Market participants are advised that the forces driving these changes are structural rather than cyclical, meaning the financial landscape of 2026 and beyond will likely be defined by tighter credit conditions and a permanent adjustment in how the United States finances its national debt. To stay updated on these and other economic shifts, subscribe to our daily financial report.